If you're thinking about acquiring a business, did you know that you could obtain reps and warranties insurance? This type of insurance is becoming more common in middle market M&A deals to replace escrow mechanisms, protect relationships with rollover management, and assure collection in the event of a breach. The M&A deal-focused professionals at ABD Insurance and Financial Services is a full-service brokerage and consulting firm, crafting innovative solutions to help address risk for clients of varying growth sizes, stages, and industries across the globe. For more information, you can visit their website at theabdteam.com or reach out to Matt Soma at matt.soma, S-O-M-M-A, at theabdteam.com. You can also listen into episode number 38, where Matt and I discuss this product in more detail. Hope you enjoyed today's episode.
Looking to buy, sell, or grow your business to position it for a sale? As the owner and managing partner of Sun Acquisitions, Dominic Rinaldi has personally been involved in over 300 M&A transactions. He has seen and done it all, consulting with large and small businesses across a broad range of industries. On M&A Unplugged, he'll interview buyers, sellers, and their advisors about their experiences scaling, selling, and acquiring businesses. On every episode, you will get key learnings, but most importantly, you will be better prepared for your own acquisition or sale. This is M&A Unplugged with your host, Dominic Rinaldi.
Begin with the end in mind. Sound advice when thinking about how to plan for an exit from your business. Our guest today, Steve Migala, has a framework for how owners should think about a potential succession or exit from their business. Steve is a shareholder of Lavelle Law with a broad transactional practice including banking, corporate, real estate, and estate planning. Lavelle Law is a full-service firm with over 30 attorneys handling a variety of legal needs. Steve, welcome to M&A Unplugged, and looking forward to diving into the exit planning framework.
Thanks for having me, Dominic.
So, Steve, maybe we could start with just a quick background on yourself. If you can give the M&A Unplugged audience a quick overview.
Sure. I'm a shareholder with Lavelle Law. I've been practicing for over 25 years. My practice areas are transactional in nature, corporate and M&A, as well as commercial real estate and commercial lending for both banks and borrowers.
Awesome. And how's the market right now from your perspective? And we're recording this in early March of 2020.
Right. I was certainly more bullish maybe about a month ago, but usually with presidential years can be a little rougher, a little more headwinds. But now with the coronavirus, and it looks like it's having a pretty good impact on global markets. So I'm still optimistic, but I think, certainly over the next month, I think we'll really kind of determine how the year might go.
Have you seen any deals starting to fall apart because of Corona?
Not quite yet, but it's certainly going to impact manufacturing and supply chains and things like that. And so it hasn't quite hit the deals that are kind of in the pipeline yet, but certainly maybe some of those that are still kind of maybe pre-LOI stage.
Yeah, I echo your comments about years with presidential elections. Our experience has been that those are usually soft years, but not the case so far this year. Now, our January and February were unbelievable, and deal flow continues to be strong. But like you said, I think we'll see what happens here as the next couple of months unfold and we see the true impact of the coronavirus.
Yeah, I think the PE firms especially still have a lot of capital to deploy. So people are still chasing deals. But it's just, it'll be interesting to see how kind of the coronavirus and everything, how it kind of works its way through the whole process. At this point, with the deals that are in the pipeline, I think, maybe not so much, but down the road, it might have a bigger impact.
Yeah, but your good point about PE with $1.5 trillion raised to invest, it's a lot of money sitting on the sidelines to find a home. So they may find it at a slightly lower valuations than they had thought a couple of months ago, though, right?
Could be, yeah. We'll see.
Yeah. So let's get into the meat of the conversation here, which is your framework for exit planning. You've put together really sort of a very nice overview from my perspective of how owners should be thinking about an exit. And I love the comment that you made when we talked offline about begin with the end in mind. So important. So many people sort of just dive in and they don't really understand what their end goal is. So Maybe you could start with what are the three legs of that stool from a framework perspective, and then let's dive into each of those.
Sure. So I think from business owner's perspective, you definitely want to start with the end in mind and get together a really good team of advisors and start planning a few years out for that liquidation event or sale. And you want to make sure, too, that along with your team of advisors and your planning, you have your estate plan ready to go to prepare for that liquidity event. And then with your team of advisors, you want to explore kind of what exit strategy makes sense for you and for the business.
It makes perfect sense. So the first leg that you talk about is the team approach, which it's so critical. I had this conversation with actually a buyer the other day who was ready to launch into buying a business and hadn't really pulled together a team of advisors. And I sort of stopped the conversation. I said, look, it's great you're planning to do this, but let's start with some things that you need to do first before you go out and start sourcing deals. And team was number one on my list. So maybe let's talk about that.
Sure. Oftentimes owners, they have different kind of priorities, I guess. A lot of times, they want to take care of, maybe trying to find the right buyer, or they have a desire to protect employees or take care of the family or whatever. So you really want to find a team that is kind of sensitive to the owner's priorities. And that team, there's a couple of members of that team you have for any kind of deals involving the sale or a liquidity event for the business. First one, of course, Dominic, is somebody like you, somebody who's more of a kind of a broker or investment banker who can really kind of determine where the business is today and build a strategy to maximize value and achieve the desired sales price. Of course, I mentioned there's a liquidity event as for any sale. And so you want to have a financial planner kind of lined up and help you manage that liquidity that's going to come in and invest those proceeds and help you build a post-sale vision for what your life's going to look like after the sale of the business. And then the people who work on the deal, people like me who are attorneys with a document negotiation and drafting, and also a CPA or tax advisor who can help with the tax structuring and minimize tax consequences. So you really want to have a team approach. You want to make sure that the team kind of buys in and understands the owner's priorities and just really kind of contributes to achieving those owners' priorities and getting the deal done.
Absolutely. The thing I would add to that too is when you look at advisors, you want to make sure that you're bringing in people who have M&A experience and significant M&A experience. There are lots of great advisors out there, but if they're not doing M&A deals day in and day out, they may not be up on the latest things that are going on, and that could cause you to leave some money on the table or maybe not even get the deal done. So I think it's really important to be talking to people like Steve who have significant M&A experience and will be able to shepherd you through the process. The other thing I would mention about financial planners is one of the first things that we ask that sellers do if they haven't done it already is work with their financial planner up front to figure out what their number is. If they need the proceeds from the sale of the business in order to retire or do the next thing, if that's go do another business or whatever, make sure they're working with that financial planner up front to understand the number. Because if you understand the number, then we all know what we're shooting for. It may not even be appropriate to be going out to the market at this moment if the business can't deliver that number. So,
yeah, I think that's true. I think that certainly when we meet with our clients, we want to ideally get them to start thinking about planning for that sale a couple of years out. There are things that they need to discuss with their financial advisor, that there are some operational challenges or things that they need to do with respect to the business to try to increase their valuation. Then certainly having that kind of runway is better.
So, Steve, let's move on to the next part of the framework, which is the estate plan from the owner's perspective.
Yeah, we do quite a bit of estate planning and succession planning, and we really like to see an owner have a sound estate plan in place, primarily with respect to how that estate plan relates to the ownership interest in the business. We'd like to have that owner with a will, typically a pour over will, and have that ownership interest often held by a trust, and also have powers of attorney with respect to healthcare and property. And what that allows for is, especially in a case where an owner could become disabled, you then have the ability, assuming the ownership interest is in the trust, where the successor trustee under the Illinois Trust Code, what previously was the Trustees Act, kind of take over ownership and management of the business as a shareholder or a member. And so just having that ability and being able to then manage the business in case of the owner's death or disability really is helpful. And also it ties nicely into liquidity event and what happens to those proceeds upon the sale of the business and how then those proceeds are managed post-sale and distributed out to the owner and his or her family.
So, Steve, at that point in time, are you also bringing in accountants potentially to help the owner think through what their tax ramifications are or how to do things so that they have the most favorable tax outcome?
Sure. Yeah, we often work with the company's accountant. They have that kind of experience. If not, we can certainly recommend people. We can handle the tax structure, but oftentimes, we will also work in conjunction with the accountant to help design that tax structure because, the accountant certainly knows the business, sometimes more so than we do, especially if we're just brought in. So we definitely are happy to work with the company's existing accountant, trying to figure out the tax structure and how to best minimize tax.
Yeah, I find that to be such an important piece when owners are evaluating the next step, or even if it's not a next step, just to understand what their walkaway number is, because I often tell people, the purchase price is one thing, but just as in, 1 and 1A is how much of that purchase price are you going to keep in your pocket? And that's so critical. I think people get surprised oftentimes at the closing table what their taxes are, and that should never happen.
Right. Yeah, they should have an idea of what the gross proceeds number is and what exactly what you're saying, what the walkaway number is after.
Yeah. So, Steve, are there things happening with trusts and estate planning and any changes in the law that would be helpful for people to understand or know, or anything that's looming out there that could impact what happens in the future? I mean, not that we want to start to predict things, but if there's anything that, you're aware of?
Well, I think what's going to happen with the federal estate tax situation post-presidential election, maybe next year, I'd want to keep an eye on that, especially if we have a change in party control. If a Democrat gets elected, we might see maybe an increase or a reduction in the exemption amount or something along those lines. So that's something just to kind of keep in mind, just to monitor. But I would say also, too, the Illinois recently enacted its Illinois Trust Code, kind of a comprehensive rewrite the Trust and Trustees Act and some other acts. And it's really business friendly in terms of what trustees can do with respect to the business. And so that's not so much new development. It is just kind of a comprehensive kind of consolidation and compilation of present law.
So is it giving trustees more leeway in managing the trust?
It's just kind of codifying really what's kind of already there under the Trust and Trustees Act and kind of developing case law. Trustees had significant abilities to manage the ownership interests of the business, both the shares and things like that. So it's more just kind of applying existing law more than anything else. But it's very helpful, especially again for death and disability scenarios, to have that in place.
That's great. And Steve, let me ask you, as it relates to family members and family members that maybe aren't in the business but are going to be benefactors as it relates to the estate and the trust, what are some of the best practices as far as an owner dealing with his family? Do you recommend incorporating the family into the discussion, or, how do you approach that?
I think that kind of dovetails in with what the strategy is going to be for how to transition the business. And we've mentioned this earlier. What's the owner prioritize? Do they want to kind of take care of the family? Is that an issue? Do they want to take care of employees? How do they want to see the business being owned and operated going forward? To the extent that family are going to be involved, I think it's certainly helpful to have that discussion with family. I've been involved in many situations where transitioning ownership to second and third generation. And it's very helpful to have that conversation and be kind of just convey those expectations from the owner to the family and try to figure things out. Oftentimes, family members are often not involved in the business. And so maybe only one or two of them maybe are. And so do we compensate, if at all, for those family members who are not going to be in the business? And if so, how do we do that? Allocate certain other assets that are not ownership interests, to these family members under that owner's trust, things like that.
Yeah, it makes perfect sense. And in the case where you have maybe an owner who doesn't have any family involved in the business, do you advise that once they come up with this strategy and plan that they then present it to their family so their family at least understands what their plan is and their strategy? Or is that something that, it's not that important and it'll get revealed when the time comes?
Yeah, I think it's helpful to have that conversation, even for business owners or non-business owners, just as for the person with the assets to have that conversation with their family members and to kind of really just give the family peace of mind in terms of what to expect. Here's what's going to happen, and can use them as a sounding board. Obviously, family dynamics kind of dictate to the extent maybe you do that, but I think overall it's something to think about doing.
Yeah. Okay, great. Anything else about that piece of the framework before we move on to the next?
No, it's like I said, it's very helpful to have that in place. And if an owner doesn't have it in place, then, to the extent that they're looking at selling the business and they do have some of that runway, maybe they started a year or two out or whatever, get those estate plan documents drafted or even updated. And it's good to have a review of those estate planning documents, every, say, 5 years or so, or anytime there's a life-changing event, whether it's a birth, adoption, death, divorce, things of that nature.
Yeah, great advice. Great advice. Okay, so let's move on to the last piece of the framework, which is the actual exit strategy. So deciding, I guess, what and how you're going to exit the business.
Right. So I think really from what we've seen, there's really kind of three basic strategies, really driven by owner priorities. First, we can do a slow sale to employees. Second, we can sell to a portfolio or a strategic buyer. And that's where kind of the private equity firms come into play. And third, what we've seen more frequently in the middle market is sales to ESOP. So those are really the three kind of strategies that,
I'm sorry, and did you say infrequently or more frequently?
More frequently.
More frequently. Okay, interesting.
We think that there's definitely an underserved niche in the middle market for ESOPs, and we think that they can be viable.
So let's talk about that a little bit. Maybe you could talk about ESOPs at a high level and then maybe dive into some of the details. And what are the pros and the cons that owners should be thinking about as it relates to an ESOP?
Sure. So really, let's kind of start off with defining kind of what an ESOP is. So it's really qualified, defined contribution employee benefit plan. And what it does, it invests in the stock of the company. So what happens is a plan is created and it's the buyer of the shares or the interests from the selling owner. And so it allows then the employees to have an ownership interest in the company, and it can provide the selling shareholders then and the company with significant tax benefits. So it could be very flexible and really a powerful tool in a variety of situations, such as an owner's retirement, if you want to buy out an inactive owner, there's an estate or divorce sale. And then often what the case too is when you have a management buyout or other takeover. So it can be a great way to give employees kind of across the board an ownership interest in the company.
And what's the tax benefit to the owner or owners of the business for doing this?
The company is a C corporation. The selling shareholders can often defer gain on the sale of the stock to the ESOP. The company contributions to the ESOP to fund the share purchase are tax deductible. So, there's tax benefits to both the owners and the corporation.
So, Steve, from a process perspective, the ESOP, I've heard that it can be expensive and take a lot of time to actually implement. Can you give us some thoughts and experience there?
There's often ESOPs can be transaction cost heavy because there's multiple parties and they all need counsel, right? So the selling owner needs counsel, the company often needs counsel, and then the ESOP trustee is there and also needs counsel. So it is a little bit transaction heavy, but we think that for the right kind of company, it can certainly be a viable solution. And there's certain characteristics that would constitute a good ESOP candidate.
All right, so let's maybe back up and move to the other one you had talked about. The first one being, just a straight slow sale to employees, maybe key employees. What do you see there?
With the slow sale to employees, this is going to accomplish a few things from the owner's perspective. It's going to allow the owner to really kind of, again, take care of the employees, preserves the owner's legacy. The owner can vet future shareholders over a long period of time. The owner can, with a slow sale, still maintain control over the company and the process of the sale, while being involved in the day-to-day operations of the company if the owner still wants to do that. There's certain tax advantages too. You can certainly, within multiple sales or slow sales, have installment sale treatment and then really spread that tax impact over time versus having, a sale of all the interests at once.
Yeah, there are clearly some benefits to doing a sale to employee, but there are some cons too, right? Do the employees have the cash, at least some cash, to come down with an equity infusion, initial equity infusion? Do you have a good, solid core of key employees who can become the management team? Lots of things to think through there. And then you always have the issue, because we've been involved in a number of these kinds of transactions, is what's the value of that business? And that always becomes a difficult conversation between either the owner and the employees, or if the owner engages an intermediary and the employees. And so that is a tricky discussion. And you really need to think through how to present that to the employee base that you're going to offer the business to.
Agreed. Yeah, you definitely want to make sure you have the right employees, certainly key employees that are going to be potential buyers. And then you have to arrange for, potential financing and things of that nature.
And then there's the next piece, which you mentioned, which is, just a sale to a third party, whether it's a strategic buyer or a private equity group or an investor group, but bringing it out to a third party.
Right. And here you definitely want to have clean books. Oftentimes owners like to run things through the business, to manage expenses through the business, to minimize their taxable income. But certainly, again, that kind of speaks to the need to kind of plan this out a couple of years in advance. You want to stop doing that and start showing taxable income so you can drive up the valuation and kind of reverse that trend. And having a broker or an intermediary is helpful to drum up market interest. Maybe you pursue some sort of auction strategy as part of that, or to explore ways with the intermediary to maximize value.
We certainly agree with that comment.
Right.
Yeah, look, it really does depend on what the owner's trying to achieve, right? I mean, there are some scenarios where owners have come to us. They have long since made their money and are set for retirement. They want to do something good for their employees, and there's a value that's not a market value that they're willing to offer to their employees, and everybody feels hopefully good about that process. And then there's others where the owner does need to take it out to a third party because either there isn't the key employee base or they need maximum dollars. And in that case, you really want to go out and bring as many buyers and as much leverage to the deal as you can, so you're getting maximum dollars and in the best terms possible.
Definitely.
Well, Steve, this has been great. As we wrap up here, any high-level comments or thoughts that you would want to share with the M&A Unplugged community to bring this to a wrap?
Just kind of the theme of trying to work with people like me and you, Dominic, who can understand really the driver of the owner's expectations, come up with a team approach, get the right advisors in place, and come up with an appropriate strategy for the sale of the business. And just trying to make sure those owners' expectations are A, realistic, and B, achievable. So I think with what we talked about today, having the right team in place and exploring the various sales strategies, I think that can certainly be done.
Yeah, great advice. Steve, for anybody out there who would want to get in touch with you, what's the best way for them to reach you?
Sure, you can just call our main number, which is 847-705-7555. That way you always get to speak to somebody live. You can also email me at S as in Sam, M as in Mary, 𝐼GALA @lavellelaw.com. That's LAVELLELAW.com.
Steve, thanks so much for being here. Really appreciate it.
Thanks, Dominic. Have a great day.
So M&A Unplugged community, let me just recap really the high level here. We talk about this time and time again, preparation. The earlier you start to prepare, the better the outcome for you and for everybody involved, your employees, the buyer coming into the business. Preparation is so key. And the three elements that Steve talked about in his framework, which I really echo and agree with, are get the right team in place. Make sure you understand how this fits into your estate plan the number is going to be the right number for you, and you're going to be able to walk away from the business and do the next thing, whatever that is, start another business, retire, whatever it is. And then third, what is the preferred exit strategy? Sale to employees, an ESOP, taking it out to the market, just determining what is in the best interest for you, your employees, and the highest likelihood of a transaction. All of today's information will be available in the show notes. If you would like to learn more about the process of acquiring or selling a business, please visit our website at sunacquisitions.com, or feel free to reach out to me at drinaldi@sunacquisitions.com. I look forward to seeing you again on the next episode of the M&A Unplugged podcast. And until then, please remember that scaling, acquiring, or selling a business takes time, preparation, and the proper knowledge.
Thank you for joining us today on M&A Unplugged. If you enjoyed the show, please subscribe, rate, and recommend it wherever you get your podcasts. If you want more great information on how to scale, acquire, or sell a business, please visit our website at sunacquisitions.com.